All right. Hi, my name is David Andolfatto. I'm with the Research Division here at the St. Louis Fed. And we're here at the 40th Annual Fall Policy Conference. And I'm speaking today, right now, with Ellen McGrattan of the University of Minnesota. Ellen has presented a paper called Intangible Capital and Measured Productivity, and she's agreed to sit down with us here today to discuss what the paper's all about. Thanks for joining us, Ellen. So why don't we just start off and just the title, Intangible Capital and Measured Productivity. So what's this paper all about?
Well, the paper is part of a kind of bigger research program thinking about intangible investments. And by intangibles, I mean things like research and development, software, mineral exploration, artistic originals. So when you watch The Gone with the Wind, you know, that pays profits to the firms that produced it, and those profits are long-lasting, and we want to take it into account that some of that is an investment. It's relevant for business cycle research, which is something I'm interested in, because when firms make large investments, and in the US they do, what can happen is you don't count it. So if you think about the national accounts of, say, the United States or any other country, when you calculate gross domestic product, prior to 2013, if you did any research and development, that would not get counted in GDP. So, for example, if we have the tech boom of the 1990s, and companies are doing lots of research and development, we have the internet coming online, big telecommunications, we would not see large increases in output. We would see large increases in inputs like hours of work, and so measures of productivity like GDP per hour or something we call total factor productivity would not seem like it's booming when the economy's booming.
But hold on a second. So, okay, so you mentioned when we watch Gone with the Wind.
Yes.
An intangible form of capital that generates a stream of income, but surely when we watch Gone with the Wind, it generates advertising revenue for the owners of this capital. Isn't the income produced by that capital counted in the GDP?
Yes.
Okay.
And
what is not counted then? The actual investment?
The investment. So if you think about, let's go back to kind of basic economics, we count our products and our incomes. So incomes to research and developers, you know, the scientists, that gets counted. To the advertisers, that gets counted. But the actual investments show up like an intermediate good. It shows up as an expense to the firm. So what effectively it looks like is that they have lower profits.
I see.
And we have lower investment. So it's counted in some sense, but as an intermediate,
I see.
Not as a final good. And so when we count up GDP produced in the economy, what it looks like is one business paid another business, but it wasn't capitalized, it was expensed. So we, the macroeconomists, don't see it. And it looks to us like output or GDP as we normally measure it is not booming when other things like tangible investment, investment in buildings and equipment, or hours are booming. So to us it looks very confusing because we think, wow, these are good times, but we don't see it in the productivity measures. So we're wondering what is going on.
So is this a mismeasurement issue more of a recent phenomenon? Because
we don't know that. So part of this study is to try to get at other, some work I've done with Ed Prescott, who's at the Federal Reserve Bank of Minneapolis and Arizona. He and I have been kind of doing different projects, looking under the hood a little bit in terms of the measurement. We had done a study in the 1990s. We have this work that I'm doing now is to try to look beyond the 1990s and see if this is a problem of measurement more generally. I'm aided with data from the Bureau of Economic Analysis. In 2013, so after we did our study of the 1990s, they've introduced some of the intangibles into the accounts. So they now include research and development. They now include software.
As Final goods.
Final goods.
But when they included it as expense items, I mean, you have data for that as well. Do you know?
We did. We always had it. We always had part of it in the. We call them the input-output tables. In the input-output tables, you'll see the intermediate inputs.
Okay.
We also saw that the National Science Foundation has done a survey since 1953. So we knew these investments were being made.
Right.
That helped us when we were thinking about the 1990s because we could go look at those investments directly.
Right.
What the BEA is doing now is to try to integrate, come up with a new concept of GDP and integrate that information into the notion that everybody looks at for output, which is GDP. That was not in there before.
But I guess what I'm getting at, but if a dedicated researcher wanted to, they could go back and reconstruct the
Yes.
actual? Okay. And
Yes.
when one does that, I guess people would be interested. What is the differential over time? Is it a lot? Has it been growing when one performs this exercise?
Well, interesting that you asked that because only about, the best guess is that only about 30% of what people have measured directly or indirectly, only about 30% is currently in there.
I see.
So it's still a big measurement
So we
issue.
don't know.
We don't know.
I see.
So we know, there's lots of indirect measures. We can see stock valuation. So
Right.
when companies make investments, their stock values reflect that.
Right.
But as you know, the stock valuations move around a lot.
Yes.
And so it's oftentimes hard to disentangle the investments from other things that might be going on that might be changing their prices. So as I said, it's kind of an ongoing, it's a bigger research program than
Right.
just this one paper to
Right.
try to get an overall sense of what these intangibles are doing to the overall macroeconomy.
It might be useful, in fact, as to set up this paper to just really briefly describe what you and Ed did in terms of explaining the 90s. What was the puzzle there?
Yes.
What was the resolution? Because if I understand correctly, this paper builds on that and is kind of like the reverse, possibly. But
Okay, so first of all, when we were thinking about the 1990s, I was at the Federal Reserve in Minneapolis, and the president, Gary Stern, kept asking us, why are hours going up so much? Why is employment booming? I don't see anything in the productivity statistics. You guys study theories where productivity matters a lot. Explain it to me. We had no good answer. We scratched our heads for years. Meanwhile, we had been doing another study looking at stock valuations where we did introduce these intangibles and then sort of connected the dots, thinking, oh, wait a minute. We could also think about this, not just about stock valuations, but in terms of business cycles, because if it's missing, in our models for looking about the stock market, it's missing in our models of business cycles. So we scratched our heads for a long time, but we figured out that the lackluster productivity measures were because we were mismeasuring the GDP. When we went and theorized, we wrote down extended the standard model. And when we extended the standard model, we saw that the big hours boom was not only showing up in the data, but also showing up in our theory once we accounted for the intangibles. Now that's a period of big boom. When you look more recently, say at the downturn of 2008, 2009, you see the flip side. So what we see is measures of productivity didn't fall very much when GDP in hours fell a lot. So that's why I got started to try to think, well, maybe that it's a more general issue of mismeasurement, that we're seeing little change in the measure of productivity with big changes in economic activity. So that has sent lots of people going in the direction of, oh, it's got to be something in the financial markets. Oh, there's got to be something disrupted in labor markets, when it could be that our old standard model actually does quite a good job in accounting for it just through movements in productivity. So, but it is the flip. The 90s was a boom. The recent downturn is a recession. But if theory's right, it should be that we see little movement in productivity, lots of movement in hours and
Little
GDP.
movement in measured productivity.
Measured
the way
productivity.
It's conventionally measured.
Right.
But so maybe this is a good place for me to ask you. Okay, so the question you're asking is one of trying to understand to what extent this intangible capital is playing into the dynamics of the measured productivity over the course of now the recession that we just came out of. You use a model to bring to bear on this question.
Yep.
Like, how do you do this? Like, what are you doing here?
So what I'm doing is, first of all, I go to the data. I look at the new accounts, how they're kind of remapping the input-output tables and redefining GDP. And I've kind of made more updates to bring some other things that I know are going to be on the included later. I've kind of made a further update. I use those new accounts to parameterize a theoretical model. So I know things like what's the share of, for each industry, how much do they spend in intermediate inputs, how much do they sell to consumers, how much do they sell to other businesses in terms of capitalized investment. I can kind of use all that data to parameterize kind of our theoretical model, updated to include intangible. Then what I do is I ask myself, well, what's the contribution of just the ebbs and flows of productivity over the business cycle from the lens of that model? So I have to use some statistical methods to basically simulate the model and using the statistical methods, compare the model's prediction with the data coming from the BEA. Okay. And the idea is to kind of have the parameters of the model move around until I get a good match.
Right.
I want to also allow for the fact that I could be completely wrong. The model could be a bad match to the data, so I want to allow some measurement error. The way I added the measurement error is very specifically. I know the old models did a very poor job matching hours. That's what we saw from the 1990s. So I allow for something that could make hours move around. So if productivity is not moving intangibles and intangibles aren't moving GDP, well, it would get soaked up by the part I just don't know. Right. The measurement error is... Okay. So if I saw that, I'd say, well, this is a poor theory of the U.S. economy. Right. The main finding is I'm not seeing that. In other words, the extended model with the intangibles included is actually doing a very good job of accounting for the cyclical activity over the U.S. all the way back to 1948.
So I saw your talk. So it's basically the basic framework is some viewers might know a standard neoclassical real business cycle model. It's quite rich, actually. It reminds me of the Long and Plosser setup with many different sectors. It's very, very realistic in that sense, many interrelated sectors. There's a presumed process of technological development that's common to all these sectors, and also there's sector-specific movements in productivity that, as far as the modelers are concerned, we just take as God-given.
Right.
Okay. This model, you go at an estimate, and it seems to fit the data pretty well, especially when you account for the intangibles. Now, so what does the model identify as the causal impulse of the recent recession that we just
it would be that, well, that's a good question, because we're taking as given that there are fits and spurts in the in total factor productivity.
In the actual, not in the measured,
actual,
right? So the actual is unobserved as far as you're concerned, and you're trying to estimate it.
Exactly.
So I guess I'm asking, was it a sectoral TFP movement, or
no,
was
right.
it an aggregate?
It was something hitting all sectors.
All sectors.
So it was something hitting the productivity. It was a common component of TFP, and it's coming in strongly for all the sectors in the model. Now, one might ask, well, why are these movements, what does generate this exogenous?
And was it actually a decline in the T?
Yeah, well, okay, this is relative to trend. So
Okay.
if you think about total factor productivity, I want you to think back to 1900, say US, all the way to 2015. With the same factors of labor and capital, over time we make more and more widgets and we do better and better. We're more and more efficient. So what I'm looking at are movements around that overall growth in efficiency. So when I think about, when I say it's going down, it's not going down because overall there's an overall upward movement in our knowledge. We get better and better at producing with the same amount of inputs of capital and labor. But there are, sometimes we're really good and sometimes we're not as good. And there can be times where there's very high total factor productivity relative to trend and low. Now there are also some negative things, like for example, when anything that hinders efficiency, so regulatory, if you increase regulations on firms, that can look like a negative or a not as good time for productivity because you're affecting the efficiency of firms. So when you put a lot, when the firms have to do a lot of, accounting for every little thing, that can look like a negative productivity shock in my model.
Sure. So I asked this question, of course, because many critics of neoclassical theory will point to what they regard to be the implausibility of these major events, these crises. It's perhaps a bit more plausible when you and Ed were talking about the boom in the 1990s. Many people can,
but they have to think of it relative to a trend, right?
Relative to a trend.
Because remember, this is not that it's going negative; it's that the growth is slowing.
Well, that's quite a bit more plausible, right?
Right.
I mean, as opposed to saying, no, I'm actually estimating that productivity contracted by 5 or 10%.
Right. They would say, "Wow, you're throwing out the blueprints."
Correct.
No, we're not.
Right.
But of course, there are things that are negative. If you make firms fill in lots of paperwork.
Right.
And that will make it negative.
Right. So this is interpreting the TFB a little more broadly to include regulatory burden.
For example, because that's what we're going to pick up.
Okay.
I mean, we'll pick up that.
So I heard you mention that one of your goals in developing, one of your lifelong goals, I guess, is to develop a framework suitable for policy analysis.
Yep.
And we've been working at this a long time, and I've been seeing this model become richer and more realistic and better. But one thing that wasn't clear to me from the talk, and I'm sorry I haven't had time to read the paper, does the model, the competitive equilibrium in your model, is that what you call it? Kind of the market left to its own devices. I don't think you're modeling government regulations necessarily.
No, so the model right now has, there's nothing that impedes competition.
So it's kind of an efficient.
Yeah.
So the recent crisis we went through was completely efficient. It was just a byproduct of a slowdown in productivity growth.
Well, that's a good question. So there are a lot of people who think, no, there were some disruptions in financial markets. That may well be. What I'm trying to push, and I was trying to push in the talk today, is the baseline that they'll typically use is the baseline without the intangible investments included. That model has no chance of accounting for what we recently saw. What I'm trying to do is say, look, the real RBC baseline, the real baseline where you have competitive markets, no frictions, no disruptions, is the one that I showed today. I want kind of to set the bar higher for people who would say, oh, I've added something to the standard model that does much better in accounting for the data. I want to say, well, I want you to start here, add the, whatever it is, financial disruption that you imagine is going on to this model and see how much over and above the movements in things that the government can't, there are regulatory things they could fix, no doubt about it. But if it's how much we're getting out of scientific progress, those ebbs and flows in scientific progress, there's nothing that the government can do about that. So we have to know kind of what our baseline is in terms of, being a little bit skeptical when people say, okay, well, now we need the Fed to do this or that, or now we need Congress to do this or that. We have to know what the policy will do in a decent baseline model that fits the data.
Well, yeah, and this is actually, I noticed from the graph, the estimated fit to the actual data. Your model to data fit looked really, really tight.
Really tight.
That just smacks, that's just basically ascribing zero role to financial market frictions in the recent episode. I mean,
Unless they manifest
most
themselves.
people are just going to say, this is crazy.
They are going to say it's crazy.
Okay, so what do you say to them?
I'm going to say, if you think that the financial frictions had some impact, it's going to very likely show up as things that affected misallocation across sectors. What we see when people theorize about the financial crisis is it shows up in a different margin, that it would affect the investment decision across time. This is saying, no, look elsewhere. If your financial frictions are having impact, it's very likely that they're having impact by misallocating factors across sectors. And so that's where I would look if I were going to make the case that it's financial disruptions. Look at the sectors, look at misallocation of capital, look at misallocation of labor.
So you don't think it could be, the reason why you don't think it could be like what I suppose Keynesians would label an aggregate demand shock, that's not plausible in light of what your data and your data tells you? Or?
Well, I don't know what an aggregate demand shock is.
Well, think about a shock that makes everybody more frightened, more risk averse. Kind of, they're less secure about investing in private label, collateral objects, and they, instead of going out and spending their money, they invest in government treasuries, for example. And so there's an aggregate portfolio substitution out of financing private capital into, say, government bonds. And so to an econometrician, this would look like a sudden collapse in private investments.
Yeah,
not a sectoral thing, an aggregate decline.
Right, and that pretty much is clear evidence it's not
It's
that.
not that. So you're saying, and this is that's the evidence that is telling you that, given that if you take into account the intangible capital properly?
Right.
Well, that's very interesting. Well, I don't know what else to say about that. That not many people are going to believe this, but I admire you for carrying on this fight, and I think there's something that we have to challenge people to confront the facts. And,
they have to confront the facts, and I welcome people to essentially say, look, I differ with you in my, I have a model. Well, models can be horse raced.
Right.
And I would like to raise the bar. I would like anyone who is ready to take on kind of the standard competitive model to match their model up to the Bureau of Economic Analysis data, take their model, do the statistical analysis that I'm doing. I would welcome that, because then it'll be very clear how well those theories do vis-a-vis the data.
Well, there you go. There's a challenge from Ellen McGrattan. Come on, boys and girls, let's take it up. Ellen, we'll end here. Could you just summarize, maybe in 2 or 3 takeaway points? How would you summarize what you've discovered here?
Well, I first should say that this is still work in progress.
Okay.
There's a lot to be done. Because what I've done is looked at cyclical movements, and they're still thinking about trends. Because when we think about intangibles, think back to 1980. 1980, there was no software industry, there was no internet. So there's more to be done to be thinking about how things have evolved across time. But the main takeaway I want is I would like people to update their baseline model, their baseline RBC model, instead of saying, hey, my model can beat that baseline, which we know is going to fail in certain dimensions because it's not taking into account investments that people have estimated to be as large as tangible investments. So my main takeaway is please try to update your vision of the baseline competitive model.
Thank you very much, Ellen.
Thank you.
That's fascinating. I appreciate the time that you've spent here. Basic takeaway for me is RBC theory lives.
Liz,
Thank you very much.
thank you.